Credit 101. Understanding and Managing Credit. Purchases can be made in two forms, cash or credit. In the U.S., credit is a very common form of payment. Those who use cash to pay for purchases do so with money that is already earned. Credit purchases involves borrowing the funds in order to pay for today's purchases. The payments are then made with tomorrow's earnings. What is credit? Credit involves a promise to pay in the future for purchases made today. It comes in the form of either a loan or a line of credit. A loan typically offers a set term or payment period, a fixed or variable interest rate, and set monthly payments. A loan is generally used when credit is extended for a car or home. The full amount is extended at the time the loan is closed. A line of credit offers you the ability to access cash at any time, generally in any amount up to the credit limit, with a promise to pay the money back plus interest according to preset terms. With a line of credit, the interest is generally variable and will change based on market conditions. Payments will change each month based on the outstanding balance. The term is flexible because the payoff is not guaranteed. The line can be reused as money is paid back. Credit cards and home equity lines are common. All credit involves a lender who pays for the goods or services in exchange for your promise to pay them back under the agreed terms. When you get a car loan, the bank pays the dealer for your car and you make payments to the bank, plus interest, to pay the loan off. During the repayment period, the lender will hold title to the vehicle, and when it is paid in full, the lender will send you the title and you will own the vehicle free and clear. This process is used for all collateral loans involving titles. A home involves a deed, which operates under the same principle, though generally the borrower holds the deed and the lender maintains a lien, securing the property as collateral for the loan. Lines of credit are issued with a specific credit limit. The lender, bank, can set and change that limit based on their lending criteria and your creditworthiness. The cardholder has access to this line of credit as you see fit. You can make large or small payments to reduce the balance and can reborrow from the line as long as the account is in good standing. A credit card line is considered a revolving line of credit. Secured and unsecured credit. Credit is either secured or unsecured. In order to determine what terms the bank will offer, they must consider the risk. What are the odds that you, the borrower, will pay back the loan? The lower the risk, the better the terms you can obtain. A secured loan utilizes an asset that guarantees the loan. In other words, if you fail to make the agreed payments, the lender will take the asset. Typical secured loans include homes, cars, boats, motorcycles, and other property. The advantage to a secured loan is that the lender's risk is lowered, giving the borrower better rates and terms. This may result in a lower monthly payment and a lower interest rate. The loan term is associated with the life of the asset. A car loan is generally 4 to 6 years because after that time period, the value declines significantly. A home generally offers loans of 30 years or more because it is an asset that tends to appreciate in value. Unsecured loans have a higher risk to the bank because they are more difficult to collect on if the borrower cannot make timely payments. Unsecured credit is said to be backed by the full faith and credit of the borrower. If you cannot make payments, the lender has very little recourse. For this reason, rates are much higher and the terms are less favorable. To establish the level of risk to the lender, we'll focus on the borrower's credit score. This is established by a history of how you pay the bills. Most lenders report a payment history to credit bureaus each month. The credit report maintains the data, and a scoring system establishes a credit score that represents your risk. The higher the score, the better terms you can gain from a lender. Credit bureaus. Credit bureaus, there are 3: Equifax, TransUnion, and Experian. Collect data from lenders and create a report. Everyone who uses credit to make purchases has a credit report. This report includes personal data like your address, borrowing, and payment history. It also records when you apply for credit and which companies look at your report. Credit score. Your credit score measures your risk level with a proprietary scoring system. The most common scoring system is the FICO credit score. This was established by the Fair Isaac Corporation and is the most recognized scoring system in the U.S., being used by approximately 90% of lenders. Credit scores range from 300 to 850. Those with credit below 600 have difficulty getting loans and will pay high interest rates for the privilege. Those between 640 and 700 have average credit and can obtain loans with good interest rates, though they may have to have assets, prove reliable income, and have larger down payments. Those with scores 740 and above are considered to have excellent credit and generally do not have trouble being approved for credit. Recent updates to the FICO credit scoring model. In August of 2014, changes were made to the FICO credit scoring model, which was rolled out in the fall of 2014. These changes benefit customers burdened with medical debt and those paying off high-interest credit card accounts. If the accounts are in collection or you are working with a debt resolution or credit card modification company, you can benefit. Borrowers with limited profiles are also being helped by the changes. For those with paid-off collections, the new scoring system will no longer count the settled or paid-off debt in its scoring algorithms. The debt will still remain on the credit report for 7 years after the debt is paid off. But once the account is settled or paid in full, it will no longer drag down your credit score. Medical bills and medical collections are also addressed in the new scoring system. Medical debt is considered non-contract debt, meaning you did not enter into a contract to open a credit line, and therefore open medical collections will be weighed less than other types of collection accounts. Considering that nearly 50% of collection accounts come from medical bills, this is an important change for consumers. Once the medical bills have been settled or paid in full, they will no longer count towards the credit scoring model. Those with limited credit histories is the last group that will benefit from the FICO 9 scoring model. FICO must gather enough data on a client to determine their creditworthiness and assess risk to the lender. Those with limited histories often do not have any score at all. The new algorithms will enable customers to establish a credit score earlier, even when there is limited credit information available. One important note is that not all lenders use the newest scoring model. Mortgage companies are known to be slow at adapting at FICO changes, and many have not yet adapted to previous updates. Car lenders and credit card companies tend to be the first lenders to incorporate updates, but there is not a uniform way to determine who is using the updated model and which companies are not. As such, you might find you are declined by one company and approved by another, based on these differences. FICO estimates that consumers with settled collection accounts or medical collections will see an average increase of 25 points to your score. What makes up your credit profile? Your credit profile includes a wide range of information about you, your accounts, and information on how those accounts are managed. Your credit profile consists of the following: personal information about you, information about your credit accounts. These are referred to as trade lines and include the accounts, balances, credit limits, and payment history. Information about creditors requesting information about you. These are referred to as credit inquiries. Information found in public records. These include collections, judgments, tax liens, and other information found in public records. Personal identifying information includes your name, current and previous addresses, social security number, and sometimes contact information. Employment history is also included in the file. When you complete a credit application, this information is imported into the system. If the information is inaccurate, you can complete a simple process to update information and eliminate incorrect data. Given that many companies now use this data to verify your identity, ensuring its accuracy can reduce hurdles the next time you apply for credit. Trade lines is a list of both open and closed credit accounts. Creditors report account activity each month. The date the company reports to the credit bureau does not necessarily correlate with the payment due date, but is generally the same day each month. The company will report your credit limit, current balance, and your last monthly payment. Any late payments over 30 days will be reported, and this will remain on your report for up to 7 years. Credit inquiries shows where you have applied for additional credit as well as which companies have requested a copy of your credit file. Inquiries can also come from utilities, satellite, insurance companies, and even employers. With credit inquiries, there are 2 kinds of access to the report. They are referred to as soft and hard hits. Soft hits are companies that are reviewing your credit because they already do business with you, or because they want to consider sending you a credit offer. Soft hits do not impact your score in any way, and you do not control who requests your report. Hard hits are indicated by places you have actively approved to pull your credit. This could be a credit application, utility, or other company that uses credit to determine eligibility. Hard hits can have a negative impact on your score. Public records and collections are captured by collection companies reporting to the credit bureau, as well as information gathered from public records. Legal judgments and tax liens are generally included. What determines your credit score? There are 5 factors that determine your credit score, based on your credit profile. Each has a different weight which determines your score. This score will range from 300 to 850. Your overall credit profile and score is a snapshot of the most recent 7 years of credit activity or the last 84 consecutive months of data reported to the credit bureaus by your creditors. For cases like bankruptcies, The data may be reported for up to 10 years after the debt has been discharged. Payment history has the largest weight and therefore the largest impact on your credit score. This accounts for 35% of your total score, making timely payments essential to good credit. Payments that become delinquent by 30 days or more will generally be reported to the credit bureau and can have a significant impact on your score. Older delinquencies have less impact on your score than newer ones. Amounts owed is commonly referred to as the utilization ratio and accounts for 30% of your credit score. This ratio is calculated by taking your credit limit and dividing it by the credit balance. For example, if you have a credit limit of $10,000 and there is a balance of $8,000, you have an 80% utilization ratio on that card. Those with the best credit have a total utilization ratio at 30% or lower. Length of credit history looks at the age of your accounts. For this reason, keeping older accounts open can be a benefit. If you keep a card open but never use it, the company will generally close the account. In this calculation, the scoring model will look at the oldest and newest accounts along with the average age of all your accounts. New credit impacts your score, and opening several new accounts over a short period of time can result in a credit score decline. Calculated into this figure is any new inquiries made over the previous 12 months. 1 or 2 applications or credit inquiries will not hurt your score, but several made in a 90-day period of time will. The inquiries remain on your report for 2 years, but only impact your score for 12 months. When applying for car loans or home loans, apply within a 2-week period to reduce any negative impact on your score. FICO realizes that many consumers comparison shop, and therefore applications for the same product over a short period of time are bundled together for scoring purposes. Types of credit used is the last factor. This evaluates your loans versus lines of credit, in other words, installment loans versus credit cards. It also takes into account mortgages, car loans, retail store accounts, and national credit cards. You want a mix of different kinds of credit for the best score. You can obtain a free copy of your credit report from each of the 3 bureaus once every 12 months by going to www.annualcreditreport.com. This website does not require you to sign up for a service and only provides a free report. You can purchase your credit score from the site. Many credit card companies now offer a free credit score with your monthly statement, so check that before buying a score. It is important to note that the score you get from various agencies will differ. They may use different scoring companies or different versions of the FICO score. Our consultants at Finance Solutions can answer your questions about your credit report and can help you evaluate your debt to determine the best course of action for becoming debt-free. Recent updates to the FICO credit scoring model. In the fall of 2014, substantial changes were made to the FICO credit scoring model. These changes will especially benefit consumers who are burdened with medical debt, those working to pay off high-interest credit card accounts in collection through a debt resolution or credit card modification program, and those consumers who have a limited credit profile, otherwise referred to as thin-file consumers. In the most recent release of the FICO credit score, Score 9, the company has made some major changes in the way they view medical debt and paid accounts in collection. As it relates to paid accounts and the collection status, FICO Score 9 will now ignore all paid accounts and collections, either settled or paid in full, in the calculation of the credit score. This is a significant benefit for any consumer who is working to pay off delinquent or charged-off accounts, as once these accounts are reported as settled or paid in full by the creditor, they will no longer have a negative impact on your credit score for months or years after the debt has been resolved. While the account may still be listed on your credit report and visible to anyone accessing your file, the algorithms used to calculate your score will no longer consider paid accounts and collections as part of the score. So the sooner you are able to successfully resolve your debts through a debt resolution program, the sooner these accounts will no longer be dragging down your credit score. The next big change to the FICO scoring model deals with medical debt reported on your credit report. Medical debt is considered a non-contract debt, meaning you did not enter into a contract to open a credit line, and as such should be given less weighting in the overall calculations of the credit score. The folks at FICO agreed, and in the release of FICO Score 9, medical accounts and collections will be differentiated from other accounts and collections and be given less consideration, commensurate with the credit risk these accounts represent. Finally, FICO Score 9 changes the way score calculations are made for consumers who have a limited credit profile and credit history. These consumers are sometimes referred to as thin-file consumers. In the FICO Score 9, the company has changed the way they calculate these consumers' scores, putting less emphasis on traditional credit scoring variables and using more non-traditional data and scoring techniques. This should ultimately make it easier for these consumers to obtain credit in the future. What makes up your credit profile? Your credit profile is made up from the following information about you, your credit accounts, and information about how you manage those accounts. Your credit profile consists of personal identifying information about you, information about your credit accounts called trade lines, information about creditors seeking information about you called credit inquiries, information about your accounts in collection status or judgments entered against you called public records and collections. Personal identifying information. This is information such as your full legal name, address, prior address, social security number, and telephone number. Each time you apply for credit, this information is provided to the credit reporting agencies who then update this part of your credit profile. If you find that this information is not accurate, most credit reporting agencies provide a way for you to append or update this information by requesting online or over the phone that the credit reporting agency updates the personal information on your credit profile. If you have not applied for credit in several years, this information may be reflective of the address, phone number, and your employer at the time of your last credit application. Reporting trade lines. This section of your credit profile, called reporting trade lines or simply trade lines, are provided by the creditors with which you currently have an open or active account. Each month, your creditors will report the current status of your account, open or closed, the current balance of your account, the available credit on that account, and the status of your payment on the account, current or the number of days the payment is delinquent. Credit inquiries. This section of your credit profile or credit report shows the creditors that requested to review your credit history. Each time you apply for a new credit account, establish new service with a utility such as phone service, electricity, or gas, or apply for an extension of existing credit, a creditor will request your credit profile in order to make a credit granting decision. The number and frequency of these inquiries can negatively impact your credit, so it is wise not to open several accounts in a short period of time. Public records and collections. Anytime a creditor refers one of your accounts out for collection due to delinquency or non-payment, the account will be referenced in this section of your credit profile. Anytime someone receives a legal judgment against you, that information will be listed here. Judgments and actions of collections against you are generally considered negative and will have a negative impact on your credit score. What determines your credit score? There are 5 factors that primarily determine your credit profile or your credit score. Each contributes a different percentage to your overall credit score. Payment history, 35%, amounts owed, 30%, length of credit history, 15%, new credit, 10%, different types of credit on your credit report, 10%. Each of these factors has a varying impact on your overall credit score. Your overall credit profile is a snapshot of the most recent 7 years of your credit activity, or the last 84 consecutive months of data reported by your creditors to the credit reporting agencies. In some cases, negative information such as some types of bankruptcies may be reported to and remain on your credit profile for up to 10 years. Payment history. Your payment history has the largest overall impact on your credit score. Your payment history accounts for approximately 35% of the overall credit score. Paying your credit accounts on time and in accordance with your agreements will have the greatest impact to improve or lower your credit score. Accounts that you pay late, even 1 day late, will negatively impact your credit score. Amounts owed. The amount you owe on different credit accounts factors into about 30% of your overall credit score. Credit utilization is a leading indicator that a given person may be nearing or has already become overextended, and therefore is unable to repay some or all of their debts. Generally speaking, you should keep your credit utilization on your revolving accounts at no more than 30% of your total available credit. The credit bureaus also look at the balances of different types of accounts, for example, revolving versus installment accounts, to determine your credit score. Even carrying a low balance on a credit card but making timely payment or paying off the entire balance each month can contribute positively to your credit score. Length of credit history. The length of your credit history is determined by a number of factors. Credit scoring companies look at the age of the oldest account in your credit profile, the age of the newest account on your credit profile, and the average age of all accounts on your credit profile. They also look at factors such as how long it has been since you used a certain type of account, and even consider the length of time certain types of accounts have been established on your credit report. New credit. The number of new accounts reflected on your credit report has an impact on your overall credit score. Opening several new credit accounts in a short period of time is one proven indicator that a person may be becoming overextended. Every time you open a new credit account or apply for an account, the creditor will request your credit profile from one or more credit reporting agencies. Credit bureaus call these inquiries, and they use these inquiries to determine if you may be trying to open new credit accounts. Applying for several new accounts in a short period of time can have a negative impact on your credit score, even if you are not granted the credit you are seeking, or you open the account and don't utilize the credit received. Generally, credit inquiries will remain on your credit report and factor into your score for 12 months or longer in some cases. Inquiries you make about your own credit report are not factored into your credit score, nor are periodic inquiries made by your existing creditors. The types of inquiries are referred to as soft inquiries and generally speaking have no impact on your credit score. Types of credit used. The mix of different types of credit accounts on your credit report makes up about 10% of your overall credit score. In general, this portion of your score takes into account the different types of credit accounts, such as revolving accounts, installment accounts, retail store accounts, auto loans, and mortgage accounts. It is generally considered good to have a mix of these types of accounts with a good payment history for each account, but you don't want to open accounts that you don't intend to use. Dormant accounts or accounts that are closed by a creditor due to inactivity may have a negative effect on your credit score. For more information, visit our website at www.financesolutions.org or give us a call at 855-331-4852.